Yes, good evening, class. Today we are going to look at adjusting and closing entries. Adjusting and closing entries are two types of journals entries that are used to update the accounts and at the end of an accounting period. So this adjusting entries are made to record revenues and expenses that have occurred but are not yet recorded in the books. Closing entries are made to transfer the balances of temporary accounts such as revenue, expenses, and dividends to the permanent account of retained earnings. Adjusting and closing entries are essential for preparing accurate and complete financial statements. So basically, these closing and adjusting entries. They are used for preparing accurate and it is used to complete financial statements. So let's look at accrual versus cash basis. So accrual basis accounts recognize revenue and expenses when they are earned and incurred regardless of when cash is received or paid. So usually this accrual basis, it is recognized when revenue and expenses when you earn it or when it is incurred. So even if you have not gotten in the money at cash, but you have even if you have not yet received that amount in cash, as long as it has been earned or it is incurred, so that is accrued basis. We recognize all the revenues and expenses when they are incurred or earned. And then we have cash basis. Cash basis accounting recognize revenue and expenses when cash is received or paid, regardless of when they are earned or incurred. So even if you've earned that money some time back, as long as you have not received the cash at hand. So usually cash basis accounting, it is basically when you receive the cash at hand. You cannot recall that you have the cash when yet you don't have the cash at hand. So here we base on cash at hand. When you receive that money in hard cash, like the organization have received that money, that's when you record, or when you're paid, that's when you record. That is about cash basis. But about accrual basis, it is when you earn that money, when you earn that when it is earned, or when revenue is earned, or when expenses is earned, that's when you record it. You record down. So let's look at the key differences. So we have the futures. We have accrual basis, and then we have cash basis. So the future, it is when to recognize revenue. So when revenue are recognized. So under accrual basis, revenues are recognized when earned. So whenever you earn the revenue, that's you record it. So you recognize that you have a revenue when you earn it. But when we look at cash basis accounting, you recognize revenue when you receive it. When you receive the revenue, that's when you recognize that the organization have a revenue. So when to recognize expenses. So under accrual basis, we recognize expenses when you incur them. When expenses are incurred, that's when we recognize expenses. So under cash basis, when do we recognize expenses? We recognize expenses when we pay, when they are paid. When those expenses are paid, that's when we recognize expenses. So when we look at accuracy, accrual basis accounting, it is more accurate compared to cash, because every every financial statement that takes place, you have to record it down, so it is more accurate. Every expenses or every revenue that you incur, or that it is earned, when the revenue is earned or when it is incurred, you record it, so it becomes more accurate because it bring all. So and then cash basis, it is less accurate, because when for example, when you sold goods on credit, so you will not record that statement until you receive that money. That's when you will record. So under cash basis, it will leave out some other important information, so that's why it will be less accurate. So when we look at complexity, under accrual basis are more complex. It is difficult. It is not easy. So under cash basis, it is simpler, because you will only record what you have received or what you have paid for. That's cash, so it becomes more simpler. It is simpler. So let's look at example. We look at, for example, we have accrual basis accounting. So a company sells goods to a customer on credit. So it means the company records the revenue as soon as the goods are shipped, even though it has not yet received the cash from the customer. So as soon as you're informed that the goods are being shipped, that's when you record down. Here you record down the transaction that has taken place, though you have not yet received the cash from that customer. But as soon as the goods are shipped, that's when you record down. So a company pays its employees salaries at the end of each month. So when we look at this statement, the company records the salary expense for the month even if it has not yet paid the employees. So whenever it clicks the month, when it is already the month, even if the company has not yet released that money, they will at the end of the month, they will record down the transaction, those expenses that they have been paid but they have not yet been paid, but they will record down the expenses for at the end of the month, though they have not yet paid to their employees. So that is accrual basis. Those are the examples of accrual basis. So we look at the examples of cash basis. A company sells goods to customer on credit. So it means the company does not record the revenue until it receives cash from the customer. So here it will not record down the transaction until they make sure they have received that money at hand, at cash. So when they receive that money at cash at hand, then they will record down. So a company pays its employees' salaries at the end of each month. So the company records the salary expense for the month when it pays the employees. So it means, for example, we are in the month of October. Today is 30th. So when an organization or a company it's supposed to pay its employees at the end of this month, and it doesn't pay at the end of this month, it will pay when it pays at the beginning of next month. That's when the company will record down the salary expense. It will record down the salary expense next month, because that's when it has paid the employees. So those are some of the examples. So let's look at adjusting entries. Adjusting entries are journal entries made at the end of an accounting period to update accounts to reflect the current financial position of the business. So basically these adjusting entries are made at the end of every accounting period to update accounts to reflect the financial position of the business. So they are made to follow accrual accounting principles, which require business to recognize revenue and expenses when they are earned and incurred. So basically, these adjusting entries, they are basically made to follow up, to see whether to follow up accrual accounting principles, to see whether these principles are taking place. So these principles are, when we look at the principle of accounting of accrual accounting principles, it says it requires business to recognize revenue and expenses when they are earned and incurred. So when you earn a revenue, or when you incurred an expense, you have to record down. So regardless of when the cash is paid, here you don't mind about the cash payment, whether you have received the cash or that you have paid the expenses. You record down as long as it is earned or as long as it is incurred. So let's look at the types of entries. The 5 most types of adjusting entries are: we have accrued revenue, revenues earned but not yet recorded. So accrued revenue, it is revenues that are earned but not yet recorded. That's accrued revenues. So we have deferred revenue received but not yet earned. We have received the revenue but we have not yet earned. Then we have accrued expenses incurred but not yet recorded. We have incurred that expenses but we have not yet recorded it. Then we have prepaid expenses paid in advance. The expenses that you pay for the next, for the next month. For example, you pay the amount excess, so it is pushed for the next month. For instance, you have this month, you're supposed to pay rent for this month. So you paid, you're supposed to pay $100, then you pay $150. So when you pay that $150, the $50 will be prepaid for the next month. So that's prepaid expense. So we have depreciation expenses, the allocation of the cost of a long-term asset over its useful life. That's depreciation expense. So let's look at how to prepare adjusting entries. So we identify the accounts that need to be adjusted. So when you're preparing adjusting entries, you identify the accounts that need to be adjusted. So that's number 2, we determine the amount of adjustment. You determine the amount of adjustment. So number 3, we prepare a journal entry to record the adjustment. So number 3, we record the journal entry to record the, we prepare the journal entry to record the adjustment. For example, let's say the company provides a consulting service to its client on 31st. The company has completed consulting project for a client but has not yet invoiced the client. The company estimates that the revenue from the project is $10,000. So to record the accrued revenue, the company would make the following entry. So it will debit accounts receivable. So it means that the accounts estimates to receive 10,000. So that's become our account receivable. We debit account receivable. And then the sales revenue, it is 10,000 USD. We credit sales revenue. So this adjusting entry will increase the company's assets. So it means the company assets, accounts receivable, it is an asset for the company. So it is increased by 10,000 dollar. And then the sales revenue, it is also reduced by $10. So let's look at closing entries and the closing process. Our closing entries are journal entries made at the end of an accounting period to transfer the balances from temporary account to permanent account. So basically these closing entries, they are made at the end of the accounting period. So they are basically used to transfer balances from the temporary account to the permanent account. Our temporary accounts are the accounts that accurate revenue and expense activity during the accounting period. So these temporary accounts, they accurate revenue and expense activity during the accounting period. It is basically used during the accounting period. And then the permanent account are accounts that retain their balances from one accounting period to the next accounting period. So this permanent one is the one that you transfer from, it retain their balances from the accounting period, then it takes to the next accounting period. That's permanent accounts. So the closing process is a series of steps that accountants follow to close out the accounting records at the end of period. So the closing process includes the steps. So let's look at those steps that are involved under closing period. So we identify all the temporary accounts. You have to identify all those accounts that are temporary. So you prepare closing entries to transfer the balances from the temporary account to the income summary account. So and then we close the income summary account by transferring its balance to retained earnings accounts. So close the dividends account by transferring its balance to the retained earnings accounts. So let's look at examples. For example, we have a sales revenue. So we debit sales revenue and then we credit income summary. And then 2, we have cost of goods. We debit cost of goods and then we credit income summary. So number 3, we have selling. We debit selling, general and administrative expense, then we credit income summary. So number 5, we debit income summary and then we credit retained earnings. So we debit dividends and then we credit retained earnings. So these are some of the examples. So let's look at one sample example. A company sells goods on credit on 31st December 2023. The company has shipped goods to its customer but has not yet billed them for the goods. The company estimates that the sales revenue from the shipped goods is 100,000. What adjusting entry should the company make on 31st December 2023 to record the accrued revenue? So let's look at the answer. The company should make the following adjusting. So the company will debit accounts receivable and then it will credit sales revenue. This adjusting entry will increase the company assets, which is accounts receivable, and then the revenue also will increase by 100,000. So here it means since the company sells good on credit, so it means here we have 2 accounts. We have account receivable. It sells good on credit. So remember, when you sell goods on credit, though you've sold them on credit, but that money you will receive it one day. You will receive that money back to the company because that money belongs to the company. So that's why we call it account receivable, because that money, it is receivable. We are going to receive it because we sold them our goods for the company. So the accounts receivable will gain 100,000. So it means our sales revenue will will credit our sales revenue, because our sales revenue will be reducing, which is 100,000. So that's one example. That's the example that we have. So I think that is all for today's lecture. We shall meet in the next lecture. Have a great day.